Let's take a look at a stock market futures fair value price. It will use the risk-free rate. It will use any dividends paid and the current price of the market or the spot price of a stock index. And so looking at the formula, you see that the price of the future is dependent on the stock index, and then it increases for the cost of financing it, the risk-free rate, decreases for dividends paid. The reason the future does not receive the dividends, the actual share owners do. And then it's adjusted for the length of time out of a year that these yields are in place. So if you look over at the information, and then you can lay it out and fill in before you write it out in the formula. We're interested in the futures price, which is a fair value price. Unfortunately named because it's really a calculated value. Pricing really is done in the markets, and so calling the calculated value a futures price is a little bit confusing. We'll call it the fair value price. So the formula we lay out, and we're just going to plug in information as we read the problem. The index is 2690. The dividend yield is 1.8%. 85 days out of 365-day year, and the risk-free rate is 1.4%. So plugging it into the formula, you'll notice that we're using continuous time, which is e raised to a rate for a period of a year or a portion of a year. And so spot times e to the r minus q. Q is the dividend yield. R is risk-free rate. And that portion of the year listed or variable t. And so when we do that, you'll find that I've calculated just that piece separately over here. You'll see that it's 1.4 minus 1.8 times 85,365. And then we'll raise that negative number, e to that negative number gives us basically 99.91% of whatever you want to multiply it by. That would be the spot value here. And the result is the fair value of the future. Now, this fair value of the future, the market can trade either side of that, and as long as transactions cost are close to that number, there's not going to be a lot of arbitrage or index trading of it. The fair value, if you want to think about index arbitrage, so that problem had the market at 2692. We calculated a fair value of 2687.5. So the future in the market is clearly trading above its fair value and is overpriced. If we're overpriced by only 1 or 2 points, probably no arbitrage would occur. Transactions cost and trading pressure would prevent that trade. But as you get out to 4 or 5 points, definitely program trading would kick in, and the market would do what all markets do: sell high, buy low. What's high? Well, the futures price in the market's the high object. What's low? The stocks in the underlying index are cheap relative to that futures price in the market. So we'd sell the future, buy the underlying stocks, and we'd wait for this difference in future to fair value pricing to narrow. And if it goes back to where it should, remember that basis is what? It's spot price minus futures price. So in the market, basis was a -2. The spot price in the market, 2690. The market was above it, -2. The calculated fair value price was 2.5 below market, so +2. So if we were to set up this arbitrage, we would typically reverse it, undo the buying of stocks by selling them, undo the selling of futures by buying the future when basis reverses. So if we went from -2 basis back to fair value basis plus 2.5 basis that day, we would definitely want our $4.50 or 4.5 point profit. The contract, 250, is a multiplier on the regular S&P contract. So each contract is worth $1,125 in potential profit. So the pricing equation is used not only to check whether or not a price is useful to hedge with, but it's also useful in arbitrage. And so that's using the pricing formula in the stock market with stock market futures, both for purposes of seeing if it's a correct price, trading near its fair value, or in this case, a stock arbitrage price.